At 4:12 a.m. Eastern Time, the liquidity vacuum opened. There was no news headline. There was no geopolitical shift. There was just a sudden, violent order flow that stripped the bid stack completely naked. Within 17 minutes, silver didn't just fall, it was executed. We watched the price plummet straight through key support, slamming into $69. This wasn't a market correction. This was a demolition. The CME just dropped a margin bomb, and the forced liquidation event we have been warning you about has officially begun. The slaughter is here. What you are witnessing right now is not a natural market movement. If you are looking at your portfolio and seeing red, if you are panicking because the spot price just erased weeks of gains in less than an hour, you need to stop and listen to me very carefully. The paper price of silver has been smashed, but the mechanism of this smash is the smoking gun. This morning, without warning, the exchange hiked margin requirements on silver contracts. This is the oldest, dirtiest trick in the institutional playbook. It is the nuclear option for the bullion banks when they are trapped on the short side. They want you to believe that everyone suddenly decided to sell their silver at the exact same moment in the middle of the night. Do not buy that lie. This is a coordinated margin squeeze designed to trigger your stop losses, flush out the leverage, and transfer your wealth into their vaults. In this video, I am going to walk you through exactly what just happened at the COMEX. We are going to look at the open interest data that proves this was a setup. I'm going to show you why the physical market has completely disconnected from this paper price drop and why dealers are laughing at this $69 number. And most importantly, I'm going to explain why this volatility is likely the final shakeout before the real repricing event. The system is breaking. They are changing the rules in real time to save themselves. Let's dive into the data. To understand why silver dropped to $69 this morning, you have to understand the weapon they used, the margin call. For the average person buying physical metal, margin doesn't exist. You pay for the ounce, you hold the ounce. But on the COMEX, the futures market is a casino built on leverage. Traders don't put up the full value of the contract. They put up a performance bond, a small percentage of the total value. Yesterday, that leverage was running hot. Speculators were long, betting on the breakout we were all seeing. The bullion banks, the entities that are perpetually short silver, were underwater. They were bleeding billions as the price climbed. So what do when they are losing the game? They call the referee and change the rules. The exchange raised the initial margin and maintenance margin requirements overnight, effective immediately. Here's the mechanics of the crash. Let's say a hedge fund holding 500 contracts of silver was required to keep $100 million in their account to hold those positions. Suddenly, the CME sends out a notice. You now need $140 million to hold those same positions. That hedge fund has two choices. Option A, wire $40 million in cash immediately to the exchange. Option B, sell a portion of their silver contracts to lower their exposure. At 4 a.m., most funds don't have $40 million sitting liquid. They are forced to take option B. They have to sell. They don't want to sell. They are bullish. But the computer algorithm triggers a forced liquidation. This creates a feedback loop from hell. As the first fund is forced to sell, the price drops. That price drop lowers the account value of the next fund, putting them below the new margin requirement. So they are forced to sell too. Sell triggers sell. The price cascades. It creates a waterfall event. This is why we saw that vertical red line on the chart. It wasn't sentiment. It wasn't supply and demand. It was a mathematical chain reaction triggered intentionally by the exchange. They knew exactly where the stop losses were sitting. They knew exactly how much margin they needed to hike to trigger a cascade that would push the price down to $69. Why $69? Because that was a critical technical support level. By smashing the price through that floor, they triggered the algorithmic trading bots, the CTAs, to flip from buy to sell. It is a masterful, evil stroke of engineering. They forced the longs to vomit their positions, and the banks were sitting at the bottom with a bucket buying back their short positions at a massive discount. They cleared their books using your panic. Now here is the part that exposes the fraud. Here is the part that proves the spot price is nothing more than a derivative illusion. While the computer screens at the COMEX say silver is $69, try buying it for that. Go ahead. Pause this video, open a new tab, and go to the major online bullion dealers. Go to your local coin shop. I'll tell you what you're going to find. Because I've been on the phone with wholesalers all morning, you are going to see two things. First, you are going to see out of stock. The inventory for sovereign mint coins, Eagles, Maples, Britannias, is drying up instantly. The moment the paper price dropped, the smart money swooped in and cleaned out the physical inventory. Second, look at the premiums. When the spot price drops this violently, the physical price rarely follows it one-to-one. Why? Because the dealers know the paper price is fake. They aren't going to sell you a tangible, scarce asset for a discount just because some algorithm in Chicago had a seizure. We are seeing premiums decouple from spot. If spot is $69, the real street price is likely $80, $85, or higher. We are witnessing the bifurcation of the silver market. B-roll of a silver bar being stamped or handled. Think about the absurdity of this. We have a massive supply deficit. Solar demand is consuming hundreds of millions of ounces. EV production is ramping up. Mines are grade depleting. The fundamentals scream higher prices. And yet, we are supposed to believe that silver just lost value? This is the paper cover. The bullion banks use the futures market to manage the psychology of the investor. If they can make the chart look ugly, they hope you will get discouraged. They want you to look at that drop to $69 and say, oh no, silver is a bad investment, I better sell my stack. They want your physical metal. That is the only reason they play these games. They are desperate to shake loose real ounces from weak hands. I am seeing reports that while the paper market was liquidating, the loadout queues at the London vaults were increasing. This means the big boys, the family offices, the Eastern central banks, they are using this dip to take delivery. They are thanking the CME for the discount. While you panic, they accumulate. While you watch the red candle, they are backing up the truck. This disconnect between the casino price and the street price is the widest I have seen in months. It indicates that the physical market is tight, stressed, and totally unresponsive to the paper games. The tail is trying to wag the dog, but the dog is no longer listening. If you think this is a conspiracy theory, you don't know your history. We have seen this exact movie before. The script is recycled because it works. Let's go back to 1980. The Hunt brothers. Silver was skyrocketing toward $50 an ounce. The banks were on the hook for billions. They were facing total insolvency. What happened? The exchange changed the rules. They instituted liquidation-only trading. You were literally forbidden from buying silver. You could only sell. They raised margins to 100%. They suffocated the market to save the shorts. The price crashed, not because of supply and demand, but because of rule changes. Fast forward to May 2011. Silver touches $50 again. It's a threat to the dollar. It's a threat to the banking cabal. Within 1 week, the CME raised margins 5 separate times. 5 times in 1 week. They hiked the cost of holding a position by 84%. The result? A massive crash that took years to recover from. Look at March 2020. The pandemic panic. Silver spot price was smashed down to $12. But could you buy an eagle for $12? No. They were selling for $25 if you could find them. The paper price collapsed while the physical price held firm. Today's drop to $69 is the same play. It is the 2011 playbook dusted off for 2026. But here is the difference. Here is why I believe this time is different. In 1980 and 2011, there was still plenty of physical silver above ground. Today, the vaults are draining. The COMEX registered category, the silver actually available for delivery, is at historical lows. They are playing this margin card because it is the only card they have left. They can't flood the market with physical metal because they don't have it. They can only flood the market with paper contracts. Every time they do this, the effect becomes weaker. In 2011, it killed the bull market for a decade. Today, it might only pause it for a week. The physical shortage is the backstop. You can print paper contracts, you can hike margins, but you cannot print ounces of silver. Physics is undefeated, and physics is on our side. So what do you do with this information? How do you survive the margin bomb? First, realize that if you hold physical metal, you have lost nothing. You still have the same number of ounces you had yesterday. Your wealth is outside the system. The spot price is just a number on a criminal's screen. Do not let them mark-to-market your peace of mind. Second, if you are trading paper or mining stocks, you have to understand the volatility. They are trying to buck you off the horse. This volatility is the price of admission for the massive gains that are coming. They need to clear the leverage before the next leg up. This flush to $69 resets the open interest. It clears out the weak speculators. It actually makes the market healthier for the next run to $100 and beyond. I look at this drop and I don't see a crisis. I see an opportunity. I see a for sale sign on the most undervalued asset on the planet. The CME has played their hand. They have shown us that they are terrified of higher prices. They have shown us that they will break their own rules to defend the short positions. That smells like fear. That smells like desperation. Do not sell into their panic. Do not give them your cheap silver. Recognize this for what it is, a desperate, coordinated attack to cover a systemic failure in the supply chain. Watch the premiums. Watch the vault drawdowns. Watch the real market, not the paper distraction. I'm going to be monitoring the Asian markets opening tonight. If the physical buying comes in strong from Shanghai and India, this $69 dip will be bought up within 48 hours. Stay disciplined, stay stacked, and do not let the bastards shake you out.